Right, guys, welcome to the second part of this first video in a three-part series of higher time frame analysis for the first day of this week and continuing from where I stopped at. Um, what I was saying was you're going to look at reference the caps forward fees to determine what level IPD is trying to reach for. And one thing you also need to consider is what direction is the market trading at, okay? So that is also what you need to consider. Where is the liquidity resting? Where is the imbalance resting in the marketplace? And where could price potentially make a turn in? So if price was on a bullish trend, where could it turn around from and then go bearish? And is there enough price action to support that price is ready to go bearish? Is there a breaking market structure on the daily? Okay, so this is all what you need to take into consideration. So now, what looking at IPD actually does, it puts you in a place where most people aren't even aware of. Okay, so you can know beforehand where the total sub setups are. You can know beforehand what institutional reference points to look at. You can know beforehand where the market could most likely reach for, where you can expect explosive moves. Okay, so this is what the look back phase is the most important aspect of the IPD data analysis. Okay, the caps forward phase is simply you're trying to determine based on price action what price wants to do in the future. Okay, so now what I'm actually going to do is I'm going to break this down for you in steps. So if you're not writing from all what I said in the previous part of this video, I want you guys to make a note and start to write. Okay, so let me remove this. I'm going to remove all this quickly. So what I want to do is I'm going to give you step-by-step approach on how to draw up your IPD. And what I want you guys to do is to go to your charts and then go to your charts and do your own homework, do your own assignments and all this so you understand what IPD is. So you don't just rely on Gene says this, so I'm not going to do any homework on this. And once I say this, I'm going to take this action. And you don't treat price like that. You need to get used to the setup so that you can have faith in the setup. You can trust the setup. Okay. So another thing I want you guys to know is higher time frame analysis is very useful for you as a trader to know where fund level liquidity will be resting. So if you guys have been on my webinars a lot, you're going to understand that I basically talk about the battle between the central banks and the fund level liquidity, which is the hedge funds. Okay, so the hedge funds make a considerable portion of the profitability of central banks. Because hedge fund just liquidity where hedge funds have surpluses around. Okay, and then it's just enough liquidity that the central banks find attractive. They're going to try to want to move price to that level because moving price to that level gets them in profit and then gets the hedge funds in losses. So just like every other banking entity, the central banks want to make profit. So they're in the business of making profit whilst you're still regulating price for all other players in the marketplace to speculate in. Okay, so make sure you also have that. So if you look at prices, usually macro moves is quarterly moves in price. Okay, so what do I mean by macro moves? If you go to your monthly or you go to your weekly or your daily, you're going to see that price has been moving in a certain direction for years. So now, if you take an example of DXY, current price action as of 2020 February, okay, you're going to see that the DXY was making higher highs and rallying since I think since 2018, DXY said to rally. So for 2 years now, DXY has been on an uptrend. This is what we call macro trend. So this is the huge trend that goes on for years. And basically, these kind of trends are driven purely by fundamentals. Okay, so fundamentals in the sense of interest rate. So what actually drives price on a macro level is interest rates. The higher the interest rate, higher the currency price, because price always wants to seek yield. Okay, so price is going to want to seek yield, and higher interest rates means higher yield for currencies, which is going to automatically drive prices higher. So this is why DXY has been rallying for 2 years. But if you also look at that same DXY, you're going to see like that for like a period of 2, 3, 4 months in the 2 year span. Okay, there were bearish moves. Okay, this is what we call quarterly bearish shifts. So now what is actually driving price on a quarterly level is IPDA. So on a macro level, I'm talking about 2 years, 5-year moves, 10-year moves. Fundamentals drive prices, which is the interest rates. But on the basis of quarterly shifts, 3 months period, 4-month period, what actually drive prices are the IPDA, trying to seek liquidity. Eventually, IPDA is going to bow to the interest, the fundamentals, which is interest rates. Okay, but on a shorter span, price is going to try to seek liquidity around this level because these are profitable blocks in prices where central banks could drive price to make a profit. Okay, before they move prices in line with fundamentals. So this is why you're oftentimes in a bullish market, you're going to see corrective markets of about 3, 4 months, 2, 3 months like that. In like a space of 2 years, you're going to see 3, 4 of this kind of setup. I'm going to show you guys examples very, very soon. So this is the essence of IPDA, to know where the fund level liquidity is and where price is potentially trying to reach for. Okay, so let's go to a step-by-step approach on how to draw up the IPD, how to reference the look back phase, and how to draw up a cash forward phase on IPDA. Okay, so give me a second, guys. I'm going to get this real quick. All right, so I want you guys to write these on your title, how to use the how to sorry, I got confused a little bit. Right, so on your notepads, write the title, quarterly shift, utilizing the IPDA, and the first subheading is the look back. Okay, so title, quarterly shift, subheading the look back, and I'm going to give you a step-by-step approach on how to identify the look back phases, what to reference, what to do. Okay, so get your notepads down and let's get to texting or writing. Sorry. So see, that's for those people who prefer to see what I'm doing. So the first thing you want to do is you want to delineate the first month, the first current trading month. Okay, delineate the first current or your current trading month. Now, I'm going to give you an example. We're currently in the month of October. So what you're going to do is you're going to reference the 1st of October, delineate your month by drawing up a vertical line, at the first trading day of the month. Okay, so note that the first trading day of the month is where you're going to pull up your vertical line. Then your step 2 now is to, okay, the step 2 now is to go back 20 days. Okay, so now let's do this. So look back 20 days to 40 days, 60 days, and reference where there was a quarterly shift. Let's do this. A reference where there was a quarterly shift in price. Okay. Oh, sorry. I think this is actually number 4. Oh, come on. That was a huge mistake. Apologies, guys. All right. So let's recap again. So the first thing you're gonna do is you're gonna delineate your month by drawing up a vertical line at the first trading day of your current month. Okay. So you're gonna delineate your lines. Sorry, I messed this all up. So sorry, guys. You're gonna delineate your your charts by drawing up a vertical line at the first trading day of the current month. Okay. Then what you're gonna do next is you're going to identify institutional order flow. So this simply means you're asking the question: is price bullish or bearish? Okay. So you can easily do this by looking at the, and by the way, all what we're doing is on higher time frames. Specifically for this lesson, we're using the daily time frame. Okay. So you're going to identify why do I keep getting this wrong? You're going to identify institutional order flow. Okay. So like I said, the easier way to do this is you're going to ask yourself a question: is price respecting bullish order blocks or bearish order blocks? Okay. If price is respecting bearish order blocks, then you are in a sell model. If price is respecting bullish order blocks, then you're in a bullish institutional order flow. Okay. That is the simplest way to look at price. So is price making higher swing points? Institutional. Okay, so is price making higher swing points? That is the question when ask yourself. And once you're done knowing what direction the market, so all you simply do is just go to your daily and ask yourself, what direction is the market trading at? Okay. Has the market been making higher highs, higher lows in the last 60 days, or lower highs and lower lows in the last 60 days? Or has the market been ranging? It's very, very easy. So you don't need me to draw up live examples for you to know what range the market is trading at. It's very simple. Okay. So the first thing you're going to do is draw up a vertical line at the beginning of your current trading month. Step 2 is to identify the market direction, which is your institutional order flow. And then step 3 is to reference all institutional points between the beginning of the current month back to the 60-day range. Okay, so now let's not say reference, you're going to identify all institutional, keep getting the spelling wrong. So all institutional reference points. Okay. Why do I keep getting the spelling wrong? Okay, I was actually correct this time. You're going to identify all institutional reference points. I'm going to put a bracket, old eyes. Okay, for example, so old highs, old lows, fair value gaps, liquidity voids, other blocks, etc. Okay, that is your step 3, right? And this is what you're going to identify. And this, guys, is what you do for your look back phase. So let me actually put this in title. Let's make this larger for people. Let's make this 20. So I'm gonna make this not bold. Text, title, step by step guide for look back. Okay, so this is your step-by-step guide for look back. This is what you want to be doing for your look back phase. Delineate your month, drawing up a vertical line. You identify institutional order flow, and then you identify all institutional reference points, and you make sure they're all noted on your daily time frame. Okay, make sure you know that you're doing this on your daily time frame. So I don't want to get you guys asking questions. What time frame is Gene using? Gene is using the daily time frame. If you want to do all this on your daily time frame, okay? And then step two is the phase two is the cast forward phase. Okay, so we're doing the cast forward phase now. We're done with the look back phase. We're doing the cast forward phase, and I'm just going to change this to step-by-step guide for cast. Cast forward phase. Fast forward, we're going to make this bold, and here we go. So back to test. First step is you anticipate market shift in a 20, 40, 60-day range. Okay. Come on, what should you do? So you anticipate market shift in 20, 40, 60-day range forward, okay? Or past current price action. Let's actually change this to past current price action, because I don't want people asking questions. So I know people are gonna ask questions. When you say forward, what do you mean by forward, Jim? Because there are always going to be people asking questions. So I'm trying to make sure everything's all clear. Okay. So you anticipate the market shift in 20, 40, 60-day range past current price action. So you're looking forward, expecting what price can do. So the key word there is anticipate. So you're expecting what price can do. Okay. So basically that's what you're doing. Okay. This is a one-step approach. Okay, so the most important aspect is the look back phase, and then next aspect is the cast forward phase, where you can anticipate a shift in price every 20 days, 40 days, 60 days, either to correct market structure or in line with the trend. So this, guys, brings us to the end of the first part of our video series. What I'm actually going to do now is I'm going to draw up a live example of what I mean, or how to utilize IPDA data ranges. So what I'm going to do here is add to watch list. Oh, come on. This is a mistake. So we're going to reset the charts here. We're going to go to daily time frame. Let's look at what price is doing. We're setting the charts there. Go to your daily. Okay, so what we're going to be referencing is Euro USD as an example, so that if you're doing your exercises or your homework, you guys can all understand what to do. All right, so what we're trying to do with IPDA is to reference where price is seeking for in terms of liquidity. Now, what I'm going to do here is I'm going to pull up the replay tool around this level, so you guys can all note how I'm doing this. So we're going to mimic like this was, this is actually current price action. So currently on the daily, this is the month of October. This last up candle, sorry, was 10th of October, which is the last up candle. So we're going to reference the first trading day of the month, which is the 1st of October. That is the first trading of the month. Like the step-by-step guide I gave you guys, you're going to put a vertical line the 1st of October, okay? And now what you want to do is you want to look back, okay? So now you want to identify where is price trading at, because that is your step 2. Where is institutional order flow? Downside or the upside? Bullish or bearish? Clearly, institutional order flow is bearish. Okay. Institutional order flow is bearish. But now we see price is taking out this order block, and if price takes out this order block, where is price trying to reach for? Price is reaching for this clean levels. Okay, so this constitutes a rejection block. And I know some of you guys have been asking me what a rejection block basically is. Rejection block is equal body candles like this. Okay, look how clean these candles are. that is a rejection block, guys. Very, very clean levels. It's going to be fund level liquidity resting around those levels. So you can expect price to trade into that level. And the major, sorry guys. So now the major clue that we can expect price to trade into this level is that price failed to respect this bearish order block. Okay, if price fails to respect bearish order block, there's nothing in terms of an institutional reference point until you get to old highs, which is rejection block around this level. Okay, so we could expect this as a turtle soup or as a break in market structure when price gets to this point. Okay, so what we're doing now is all right, so now let's look at the look back phase first. Let's identify all institutional reference points. So if we go back in the range of 60 trading days, okay, so we're doing 16 trading days to encapsulate 20, 40 trading days also. We're going to do stop here because price doesn't actually extend all the way out. Let's see. So 60 trading days moves to 40 trading days moves to 20 trading days. All right, so now what we want to be doing around this level is we want to look for all the institutional reference points in this level. Okay, so this is a 20-day IPDA high. Going to write that way. So we're going to write 20-day IPDA high. I don't know why I keep calling it IPDA data when data is actually in D. So forgive me, guys, it's actually IPDA, not IPD data. So this is a 20-day IPDA high. Why? Because from this range falls under the 20-day period. Okay, but the next reference point is we're going to use the midpoint of this candle as a possible main threshold. If price rejects off this level and wants to trade higher, this could be a potential retracement back down in price. So we're going to label this 40-day main threshold order block. So that is a bearish order block. Okay, 40-day main threshold bearish order block. Let's make this fonts actually smaller. More fonts. Okay, so that way our charts are clean. Then old eyes, 40-day old eyes. We're doing this step by step, identifying all institutional reference point. 40-day old highs. We're gonna look back again. Let's see what level is next. All right, so the old highs basically falls inside this order block. So there's no point to reference this because once price gets to this level, price is essentially trading back into this order block. So the next level to reach for is our 60-day ejection block, which is this clean equal body candle. We're gonna write 60-day ejection block. Okay, so we're looking at price to the upside, and then let's look at the downside. To the downside, we have daily rejection block around this level. So we're gonna put this here. This falls under the 20-day. So anything inside current price action back to 20-day, we still reference that as the 20-day IPDA. So this is 20-day, or we could just write 20 IPDA. So limit the time we're spending on text or writing all this text. So 20-day IPDA low. Okay, so if price actually goes bearish, this is what we're going to be seeking for as price target. We're not actually using this bearish candle because you can see price reacted to this inside this candle. Price has reacted to this bearish candle. So there's literally no point why we want to use this level as a bearish order block. If price comes back to this level, we can expect price to trade straight through because price has tested all these levels in the past. So what we have now is price is basically in the middle of a range. Price is taking out this bearish order block, and we can see potentially higher prices into this level. So what I just did now is the look back phase. Okay, I did a look back phase. Now the next thing to do is the cash forward phase. Cash forward phase is you're simply anticipating where is price trying to reach for. Now I'm giving you clues why price would most likely want to reach for this level short term. Okay, price would want to reach for this level because this is basically like equal highs on the daily time frame. 1, 2, 3, 4, 5. Look how clean this level is. And if you look back in price, Price has been downtrending for a very long time. So you know there's going to be a lot of trend-based traders chasing this down move. And if everyone is chasing this down move on a fund level basis, what would your stop losses be? Old highs, old highs, old highs. Okay. So everyone will have stop losses around this level. And then it would then be logical for us to expect price to trade into this region because it would be profitable for the central banks to move price into this high. Now, the next question is, we want to note how price reacts on this high. Does price quickly trade into this high and then quickly pull away? Or does price trade into that high and close solidly above the high of that candle? Because if you see a solid close, really, really solid close above the high of this candle, that is going to indicate a shift in market structure to the upside. Okay, lower lows, lower highs, lower lows, higher high. And then we can expect higher low, higher high, like that. But if we see price quickly just spike this level and quickly pull away, then we know that was a total soup, a stop run to get this level. Then price could start to seek this 20-day IPDA low. So this is the way I want you guys to look at price. Okay, so now let's do the replay. Let's see where price reached for. Okay. So there was a bearish shadow block around this level. I'm just going to eyeballing all these levels so you guys all know. Eye of this bearish shadow block, price basically came to the eye of this bearish shadow block, bounced off, and now we've reached this high. So now, like I said, I want to know the way price closes around this level to see if there is actually a break in market structure or a shift in price. Now, price closes solidly above the 20-day IPDA high, closes above the main threshold of this candle, and if price closes above the main threshold of this bearish order block candle, this no longer is going to be a reference for downside. Okay, because there's nothing now to reference for bearish prices. So we know the next target to the upside is 40-day old highs. And this is actually a break in market structure. We can see retracement back down to most likely this bearish order block. Okay, either this bearish order block or this old highs, and then we could expect price to trade to the upside. Okay, so I want to know how price reacts. Well, now the next level to reference institutionally is our 40-day old highs. Okay, so let me actually remove the vertical lines because we basically already know where our institutional reference points are. So we're not going to consider this downside until price starts to show tendencies that it wants to take out this level. So for now, we're looking at all upside objectives. Okay, we're looking at all upside objectives in price. Let's see what price does if we can get to our next institutional reference point, 40-day old highs. See, all right, so now we've met the 40-day old highs. The next institutional reference point is a 60-day rejection block. So now look at the way we're looking at the market in phases. Okay, so we had our first target here. Okay, price broke through. Now we know we're bullish. We can expect a retracement and more bullish, probably more bullish prices, and prices smashed through. Now we want to see how price reacts off this level. We can say expect a retracement back down for higher prices. Okay, so I want you guys to know that. So there's a bearish order block around that level. There's also a bearish order block around this level. So actually, I'm not going to use the weekly average candle because price has beat the high of this daily order block, bearish order block. So I prefer to use the midpoint of this candle as a potential long entry should price reach for that level. So I'm going to draw this. The midpoint of this candle is going to be where I can expect price to reach for. Open to the midpoint of that candle because essentially those two candles are bearish order block. The open of the candle. Now, the reason why I'm not using the eye of any of these bearish order block candles is because we've seen a reaction of that eye. There's a price reaction of that eye. So we can expect price to trade through because price has been efficiently traded at this point. The next point to reference in terms of any upside movement is the open to the midpoint of these two down candles, which will constitute a bearish order block. Okay, so now price is trading higher. Let's see what price does. Okay, so price basically has taken out its old highs. Remember, if you want to consider this a break in structure, we want to see price quickly pull away. But now price is showing signs of stalling. Okay, bearish candle. If price shows willingness to go down, we can expect that we're reaching for this level. So now what we're trying to do is we're not trying to catch the eyes of this level. We're waiting for the market to show something, and we're going to do what the market is basically indicating. Okay, so let's see what price action is going to do. All right, so price is showing willingness to trade to the downside. We could look for a retracement, either to take out this eye as a breaker, or look for a retracement as a failure swing back up to this level. We could sell the correction back down and wait for higher prices. Okay, so actually, we're still in the month of October. So the next month we're going to reference in cash forward is November. Okay, so should price start trading around November, we're going to do the same process all over again. I find this comfortable doing this the first of every month as opposed to doing this every single day. So that way I know what levels I'm looking for. Okay, so until the 1st of November, we're not going to do the entire look back phase thing. We're just gonna see what price does. Okay, so this is our cast forward. So you want to be casting forward every 1 month. So each new month you're doing the entire look back phase again, referencing where price is. So for me, this makes everything convenient for me. Okay, so that way I don't have to do this every single day, looking for the look back phase, like 5, 6, 7, 8 currency pairs. So we can expect price to trade down to that level in terms of downside. Sorry, we can expect price to trade down to this old high level in terms of downside. So price is essentially taking out the main threshold of this 40-day. So we're going to delete this, So we can expect a retracement back down. And let's see what price does. Up. All right, so price gives us a failure signal like we expected, and price trades down to our first level for corrective structure. Now we want to see how does price react off this level. Does price show willingness to go higher? If price is showing willingness that it wants to rally, then we know the next level is this old high. Okay, this old high, and then if you shoot this old high is where we're going to reference, and that would be 20-day IPDI. So why do I call this 20-day IPDI? Because if you put your vertical line at this last bearish candle and you look back, okay, this is going to fall under the last 20 days. So this is called a 20-day high, okay, and that will be a good target for our next buy side before the 60-day rejection blocks. So we want to see how price reacts off that level. We can look for buys or, all right, so price is showing me a straight higher around that level. We could potentially get higher move, or we could also potentially trade down into this level and get higher prices. There's also objective. Let's see what price does. I would basically like to see price close above this last bearish candle before I see any upside. So, all right, so we've seen price showing willingness to go to the upside. We know for a certain that price is trying to reach for this level. And okay, price takes out that level. Now price, let's see if price still respects this level. If price is not showing willingness to trade higher, then probably it wants to correct back down because there's kind of like a fair value gap on the daily inside this range. So let me highlight that for you guys. So there's a fair value gap inside this point. And if price shows willingness to trade lower, then we know price wants to fill up this fair value gap. And this fair value gap is a 20-day fair value gap. Okay, that's an institutional reference point, 20 IPDA FVG. Anyways, so this actually falls under 20 IPDA. Using the same thing I taught you guys. If you use this current down candle, if you go back the last 20 days, this is where this fair value gap falls out. So all you just simply do is do something like this and shift price back, and you can see this actually falls under the last 20 days. So that is going to be a 20-day fair value. I want to see how price reacts off that level to know if we're going to buy or sell. So let's actually see what price does first. Okay, price is showing willingness it wants to trade higher. Let's see what price does around that level. Right. So price has taken out this level, trades into a 20-day fair value gap. We're looking for willingness for price to trade higher into that 20-day fair value gap. If price takes out this level, then we know price is reaching for this level around that point. Now we've reached a new month. What we're going to do is we're going to repeat the same look back process again. Okay. We're going to identify all institutional reference points. First 20-day sample average, 20-day, 40-day. Okay. This actually is 39 and 60 lastly. That is our institutional reference point in terms of IPDA data ranges. So you're going to take out this line. Basically need those text. So we have a daily rejection block, equal body candles, 20-day IPDA rejection block. So that's a 20-day IPDA swing low. Write this down. 20-day. No, let's actually make this 20 IPDA low. 20 IPDA low on that level. Okay. 20 IPDA low. This actually falls under the 20. So 20 IPDA high. So these are all institutional reference points where price is going to want to seek for on the higher time frame. And reference all institutional points, 20 IPDA other block. So we're going to use OB. And this becomes 40 IPDA low. This is actually a 40 because it falls in the second box, which is a 40 IPDA. And then lastly, the swing low. This is going to be 40 IPDA low. 40 IPDA. So that is all what we're going to reference in terms of institutional price action. And we have basically just, this could be a mitigation block because price retrace higher, took out this candle. So this is a daily mitigation block. We can expect a retracement back to this level. The price shows willingness not to trade higher from that level. To seek these levels and these levels as downside targets in price. And should price retrace back to the upside, this is a mitigation block on the daily time frame. So that is a 20-day bearish order block. Sorry, not mitigation block, 20-day bearish order block. Okay. So let's see what price does. All right, so price broke through, price has tested this level, 20-day bearish breaker. If you actually pull out your Fibonacci, you're going to see this was the midpoint of this breaker candle the price tested. And let's see what price does. If price does not show willingness to respect that level, then we're going to want to reach for this level. And then if price does not show willingness to want to trade higher from that level, we're going to want to reach for this level. So this is how we look at price using IPDA. Let's see what price does. Okay, price is at that level. Price is showing signs of stalling around this level. Let's see if price is willing to trade higher. Okay, so price, we know for a certain now that price is reaching for this level. Price has retested very short block. Let's see price reach for that level. And let's see. Okay, price is retracing. If price is retracing, where is our nearest institutional reference point? Okay, so this is a 20-day. We're referencing an institutional point, 20-day mitigation block. We can call that breaker. So now this is of no value because price is taking out this level. So no longer value to us. No longer value to us. We know now that the next downside level is this level. And price is showing willingness to want to trade down. So this is going to be the level I want to look at for downside prices. Okay. So let's see what price does. All right, so price taps this level perfectly. The midpoint of this bearish candle again, that is where price taps. If price fails to respect this level, so let me actually put a line there, the midpoint of this bearish candle. So I'm actually just eyeballing this. Normally I would draw a Fibonacci to a real world scenario as well. We're actually just eyeballing that level as a mitigation block midpoint. If price closes above this midpoint, then we know we're reaching for this bearish shadow block. And if price fails to respect that bearish shadow block, we're reaching for this level and then higher prices. So that is the way you want to box in price. Price is showing willingness to trade to the downside. And we know for a certain now that price is reaching for this level. Okay. Price is going to want to reach for that level. And we're going to see if price wants to trade back into that level. So now let's see. Okay, and by the way, I want you guys to note that at the start of December, we do the same process again. Start of every new month, you want to do the same process again. Okay, so price stops at level. Now, price is showing, there's a very nice down, up close candle around this level. Price is showing signs it wants to trade higher. Okay, so that is a very good thing we want to see. If price is showing signs we want to trade higher, where is our institutional reference point? Boom. Okay. Our first institutional reference point is this bearish order block. And then the next is 20-day bearish order block, then 20-day rejection block, then 40-day, because by the time you get to this new month, this is actually going to be a 40-day level. So let me actually just replay quickly to see how price reacts to that level. So price smashes our first to target. Price is showing extreme bullishness. Price has taken out this level, and now we know price is reaching for this level next. There's nothing on the downside to reference institutionally. Okay, and also I want you guys to note that there's a daily fair value gap inside this point. Daily fair value gap to that point. So that is going to be a 20-day fair value gap. So let's see what price does. Price reaches that level. And let's see. Okay. So you can use this as a level. Downside, should we see correction in price? So let's see what price does. Should we see price showing willingness to trade higher from this level? So we know price is reaching for this high, most likely that high. I'm going to play this on full speed because we're at the end of our lesson, and eventually price reaches our target. And that, guys, is everything for our first part of my 3-part series. Hope you guys study this and hope you guys receive value from this. So thank you all for being a part of this. And I'll be dropping the next video very soon.